Very good morning. You're watching India Market Open, and are we set for the big bang today? Can we get to 25,000? Can we close off this pre-budget week with a complete knockout while US markets and Asia are floundering a bit?
Yeah, I was mentioning this in the digital trade setup, Tamanna, that if you can plot a chart of what India has done versus what the rest of the world markets are doing, we are a far cry. But I mean, if the markets do as well as the rains are in Mumbai, we are at 26,000. But that notwithstanding, let's see. Tech is good, Tamanna, but the rest of the world market is not supportive. We've had a bit of a rally. I don't know if people will sound on the bugle of caution ahead of the budget. That's the question.
So FII flows have been good. I think that is very heartening. You're right. It's all about tech. The broader markets, even in India, look at the close yesterday.
Exactly.
The broader markets weren't that spectacular. In fact, you had nothing great happening. So people may not have. I mean, the retail investor or the average investor may not have made a lot of money unless they were really in on tech, which everyone told them not to be. For the last several months, people said, avoid tech like the plague. Well, look at what Infosys has done. I mean, the Infosys ADR overnight, I don't know if you can pull that up, but about 8% up. So Infosys is the story.
Yeah, most certainly. I mean, there is a persistent which is also slipped in, but you are absolutely right, Taman. I mean, headline number, heavyweight stock, and after the run-up that we've seen to come out and raise the guidance the way they have, quite stunningly.
All right, so Infosys is exciting. That ADR is about 8.5%, a little more than 8% up. But let's look at what's happening in US markets, and I think the story is about two guys, Trump and Biden. Will he?
And a woman, maybe?
Kamala, maybe, the women on both sides, right? Usha versus Kamala, but so that's exciting. By this weekend, will we see Biden stepping down? He's already said that if I win a second term and I can't continue because of health reasons, then I'll hand off to Kamala. I mean, I don't know if the Democrats are going to let that go. But nevertheless, US markets are also interesting. There's been a sell-off across the board. The Dow was down over 500 points. The Nasdaq down 0.5%. S&P 500 didn't fare too much better either. Dow futures are flat at this point, so a bit of recovery there. But what's happening in the US markets is not frightening, I would say. It's more of a rotational a play where people are taking a breather from tech stocks. Because if you see indices like the Russell, it's doing much better than what you are seeing your mainline Dow Jones and Nasdaq, etc. doing. The reason for that is that the bet is that the Fed will cut rates, the economy growth will spurt, and then you will see a broader based kind of a run up rather than just what we've been seeing. So let's play some of those graphics if we can and just talk about what really is moving in the US market. So that's one of the key reasons that you have the focus out of tech stocks. Big results which are going to be watched over Friday's trade, and that's also going to move the US markets to some extent. And like we were saying, Joe Biden in focus. Will he, won't he finally step down, be forced to step down maybe by the end of the weekend? That's what's going to be watched even as we are seeing profit booking. Another very key data point which came up in US markets was the jobless claims. And remember, the whole bet is that the Fed will cut rates in September. The jobless claims have actually pushed that forward at 243,000 versus estimates of 229,000. We're missing 10 there, but you get the drift. So basically, jobless claims have come in higher than what was expected in the July 13th week. And that really points to an economy which is in the need of a rate cut, I would say, slowing down in some parts. So that has boosted those hopes. The 10-year Treasury yield as a result at about 4.2% because of this. So that was steady. We've been talking about Joe Biden, and that really is going to be the next big trigger. Does he step off? Who's the Democrat candidate? Are we looking at the possibility of a Trump comeback with even greater conviction? And that's going to really be the next big mover. The markets seem pretty poised for a Trump return and quite happy with that idea as well. Meanwhile, let's just look at what's happening with crude. Crude prices actually pulled back after really being strong. So you had Brent at 84 levels, 84.5 actually. So a bit of a slide over there. Crude prices are not being able to sustain their up move very strongly. So that's the important bit to remember. As far as Asia is concerned, Asia has opened weak, and a part of it is because of that rotation out of tech stocks, right? And the concern that the whole buzz around semiconductors, etc., is going to be hit. So a lot of those kind of stocks are not really moving. You're seeing all of Asia in the red. The implied open on the Nifty, though, indicates that we are going to do well. So we're going to be outliers. And look at what's happening. This is interesting. So while the US markets are focusing on the broader indices instead of the key ones, in India it's quite the opposite. We're all about the Nifty. We could open about 44 points up, boosted in large parts, I think, also by foreign flows. Look at the fund flows which have come in yesterday. Just 5,000 odd crores yesterday from FIIs who put in money. DIS pulled out about 2,904 crores. And we pulled out that figure for the week so far, which is upwards of north of 10,000 crores. And remember, there was just 3 trading sessions. So we're just talking about Monday, Tuesday and Thursday. And FIIs have bought nearly 10,500 crores in these 3 days. So that's a good setup, especially if FIIs continue their buying.
Most certainly, and well, that will be the very interesting thing. Let me quickly do the trade setup, and then of course, I think Samina will join in just moments from now as well. But frankly, not too much to say, but for 2 pockets. I mean, we will probably start off well. Question is, can we hold on there? Because keep in mind, it's been a really strong pre-budget rally at odds with what's happening across the world. So while IT buoyancy continues because of Infi, this 1 month performance of the Nifty at 5.5%, IT led predominantly by technology, by the way, not banking, not anything else, technology and oil upstream. Can that continue is the key question, or will people come and say that let me take some bit of money off the table? I'll also tell you why. So that is one thought. So tech buoyancy continues today. Will we see profit booking? That's the first part. 2, oil upstream. Tamanna highlighted how oil has come off a little bit as well. The stocks have had a really strong run. Do we see some bit of profit booking in oil upstream after this one set of initial run already done is the key question. Now remember, Cities raised the ONGC target today to about 370. So I might well have egg on my face when I'm saying this. But some of the stocks have had a fabulous move. But is this the first set of up move done? And do the stocks see a bit of a pullback? That's the second question. And amongst the other reasons that I say this is that no other than Chris Wood has laid out in his note that, bhai dekho, I do not expect that there will be a capital gains tax of a very high magnitude. The thing is, he's hedging his bets, wherein he's saying that it's very unlikely that there will be some bit of tinkering. However, he says, still, if the view turns out, and let's go on to the next one, that to be wrong, still the view turns out to be wrong, and the capital gains tax is increased materially. He uses the term materially. Then it will likely trigger a bigger correction than what occurred post the election. Now, the question, Tamanna, Samina, is only this, that will the market, which has had such a strong run-up, come and say, hey, ahead of the big event, let me actually enjoy the gains that I've made instead of it being paper profit, take some money off the table, let's wait for the event to go by.
And come back in
again. And then come back in again, because we are at stretch valuations, guys.
Wouldn't that have happened yesterday?
Well, yesterday tech has aided. Maybe today too, we'll start off well.
Just to bring my little bank in as well. They've also done a little bit of, coming back in. So financial services were up 0.6%. You had, of course, not a 2% rally that tech did, but after many weeks of doing a time-wise correction, staying in the zone, they are trying to do their piece as well. So 0.7% gain on Bank Nifty wasn't too bad either, Niraj. I know you're talking about how tech has done the heavy lifting, but Bank is coming back in.
Coming back in, yeah. But so will we see some chips being taken off the table is the question ahead of the budget.
I think that's wise, but I guess greed is still very real. And I mean, look at it, case in point, Asian Paints, huge disappointment on earnings front. The stock still saw gains coming in. There was still a long build-up in terms of the F&O activity. So if there is apprehensive, if you are taking chips off the table, which chips are you taking off the table? I think that's the question to ask.
Not consumption, I would say, because the overwhelming bet that this budget will try and boost consumption is coming in. I mean, yesterday, Sanjeev Puri told this to us as well, and we'll play that out. Now, if ITC is saying, yes, I am seeing green shoots, but I need a more sustained rural recovery, and I think that the government is going to do something to boost consumption, I don't know if people are going to, dump an HUL, Nestle, ITC, Asian Paints right now.
And I think taking profits could be one thing, but let's not forget a lot of the money coming in is SIP money. You may pause future SIPs, but will you start withdrawing money? There's also long-term capital gains, right? So you've got to be ensured that you're in the market for a year. So a lot of math that goes in.
That's the different texture this time around versus the previous
what we usually
rallies.
see. And if you talk to an advisor, they're going to tell you, maybe you can take profits off the table, but do you stop allocating?
Yeah.
No.
You don't stop allocating. And
that.
that's what you do, right? You want to keep allocating at various dips and various highs. That's the only way to, I guess, average out your entry points. But like Tamanna and Niraj both said, this market is dancing to its own beat. It's up for 45 points on the index, still away from 25,000. Of course, the newsroom was abuzz yesterday, thinking and hoping that 25,000 gets taken out today. I don't know whether there'll be any weekend cheer on the street, but even if we don't take out 25,000 today, we still have Monday before the budget. So maybe the markets want to, keep that excitement going, see small gains. But Niraj, you might want to quickly comment on this, and I think we were discussing this as well. Yesterday, you saw gains on the street. The breadth was terrible. The day before that, you saw gains. The momentum is fading. Now, is this what happens often when new record highs are made? There is a lack of momentum at higher levels, or this time it's slightly different?
No, I mean, typically the small caps will start giving way first, and then the large caps give way even quicker, or rather give way, and then the small caps see an even bigger reaction, right? I mean, I saw Devina Mehra post as well, which cited the previous instances wherein the pullback has happened from highs, that the small caps don't give you a chance to exit at times too. So that's a problem. But
liquidity.
I do think, Samina, the point that you made earlier is a very valid point, that this time around is slightly different simply because of the SIP money and mutual fund investors being forced. But, one statistic, just one statistic, even if a correction comes in, could it be a very shallow one? Because, guys, an average mutual fund is sitting on 8% cash.
So much more to come back in with.
There are three which are sitting at 2%. There is a PPFAS, cash and cash equivalents, 15% or thereabouts. The total cash sitting on the sidelines in the mutual fund books is 1.25 lakh crores.
Wow.
Yeah.
That will come in if there is a sharp correction. So I think it will be a swift one if it's a sharp one, or else it will be a shallow
correction.
correction.
So there is enough money sitting on sidelines. SIPs are not getting paused, and I think that's the right and the wise thing to do, because who are we to call a market a bottom or a top, right? And this is what we've learned in the past, that it's truly not that easy. When there is the flow of money, you don't fight it, but at the same time, you've got to be a little more pragmatic. If you're an equity player, work with trailing stop losses. Take profits off the table. Those are things that advisors would tell you, be wise at this stage, but calling it a top is anybody's guess. But let's go into stocks, and we've talked about how IT has turned the corner in some ways this quarter. We saw a good performance. I mean, we did get excited with TCS. They talked about a very optimistic outlook. We saw LTIMindtree actually walk the talk, where they've managed to have a good quarter. They did say that it's too early to call it a trend reversal. We still don't know whether it's a flash in the pan, but signs are indicating that this recovery is here to stay. And with what we saw with Infosys last evening, the markets are definitely going to be pleased. Good set of earnings all the way from the get-go, and I think what stood out for them is not the performance just this quarter, it's the commentary. And with tech companies, we usually take heart from what they say in terms of the outlook. Given the context that the US goes into election, the US is the biggest market. We all know Trump is great for business if he comes back, which is what the market is betting on. Tech is going to see a good sort of traction and a return to business in that sense. In fact, decision making has improved and TCVs have improved. So all those factors indicate that good times are around the corner for the IT sector. Quickly highlight Infi numbers. We'll discuss this in more detail. Revenues were up by 3.7%. It was a beat on revenues. EBITDA was up 8.9%. Margins have also improved. Now, this is what is a standout for the 2 out of the 3 IT companies, the big ones that reported in the last few days, where margins have actually gotten better in this quarter. Net profit was down. There were large deal TCVs also down about 8.9%. But in terms of guidance, and I'll take you through what they've said, they've very clearly said that it's a beat. they internally seem quite pleased with what they've done, and I think that's what is standing out for us in terms of markets. In terms of what they've done with their numbers, let's quickly highlight that for you as well. They've raised their revenue guidance. It's the 6th time in the last few quarters they've actually gone out and changed their guidance. This time they've raised the guidance to 3 to 4% from its prior view of 1 to 3%. Operating margins have come in at 21.1%, which is 30 bips higher from 20.8% in the year ago. Number of large deal wins were highest ever at 34 with a valuation of $4.1 billion, which is 57.6% being net new client additions. Free cash flows also stands at 9,155 crores, up 59.2%. So all in all, good set of numbers. I think Niraj has looked at it in a little more detail. He heard out the conference call as well. So there'll be more intel on that. But brokerages as well seem quite impressed. I think there are a few buy calls and price targets being raised on Infy. And you're smiling away. Is that really a great set of earnings?
No, because I did attend the con call.
Yeah.
And just one small thing here. The 4 have come out. It's been 1 versus 3. And both on margin expansion as well as growth numbers, Infy is far outstripping the other 4 that have come out thus far. Could Tech Mahindra do better than Infy? Maybe. But thus far, Infy within the 4 is slightly ahead of the race. And maybe that's why the ADR is showing what it is showing.
I would argue that LTM Mindtree was also actually really good. I did talk to the management yesterday, and the good thing is that they're picking up businesses from new verticals and new client additions. And they've also said that while the deals have come through, and it may not show in terms of what they report, these are all 18 to 22 month deals.
Okay.
Which means the cash flow as well will continue, renewals will happen. So quarter on quarter, you're really just putting on the building blocks, right?
I would just say they're in a different league. Infosys and LTI Mindtree.
Well, this
right
is now, I think with post the merger, I think they're all the big boys on the table, right? But yeah, Infy is the old hand at the game.
So just to talk about what brokerages are saying on Infosys very quickly. So Bernstein, maintaining an outperform, has raised target price to 2100 from 1650. Citi has raised its target price to 1850 from 1550. So hefty target prices up there. All of that on your screen right now. Only Citi seems relatively not that excited. Jefferies has maintained a buy, raised the target price to 2040. Nomura, Morgan Stanley, everyone is so bullish on Infosys. I mean, yeah, they got it wrong on one stock yesterday on LTI Mindtree, but that I think Infosys is going to see a great start.
Just one last point here. Both for Infosys as well as Persistent that we'll talk about, the beauty was that North America and BFSI showed an impressive move, which is the bugbear for them if they don't do well. So that I thought really stood out for Infosys as well.
Well, yeah, financial services grew quite significantly, and that again we saw across segments. Even India has done well for Infy, which is again similar to what happened with TCS. In the case of TCS, it was only India that grew, but of course with Infy, it's also India that's grown. The ADR looks excited. That's what's going to keep us all very happy this morning when the stocks see the big gap up in trade. Well, the other one which didn't impress, but of course sounds very optimistic about the future, is Tata Technologies. Their net profit has fallen about 15% to report at 162 crores on back of its service segments actually shrinking in this quarter. Now, 70% of Tata Tech's business comes from the services vertical. That has seen a degrowth, on back of which the top line has been impacted. They also had higher expenses, so that was the other factor that's impacted the bottom line for Tata Tech. Their service revenue stood at 985 crores, so it's down marginally. It's no growth, but quarter on quarter there's a decline, and year on year as well we've seen a similar sort of picture playing out. Tata Tech, in its commentary, said they won 5 very strategic deals across the automotive and aerospace verticals, and the VinFast transition now is behind them. So anything to do with transitioning and of course merging the entity is now behind them in terms of the org chart and of course in terms of moving ahead. They seem very optimistic. They say they see green shoots. They're confident about the outlook. They expect the positive momentum to continue with the anchor accounts. Good news is they haven't lost any big clients and they continue to add clients. So that could be the positive on Tata Tech, but I guess it is in the shadow of Infosys this morning, which has reported such strong earnings. So I think the bias, if there is a play, will be on Infosys instead of Tata Tech. Well, you also have Shoppers Stop, but do you guys want to go into the bigger ones and then we can come in on Shoppers Stop because those are slightly smaller companies?
Sure. Just on Tata Tech, after a bumper listing They have just every quarter seemed to, I wouldn't say disappoint, but not really live up to maybe what expectations they were, and very inherent issues seem to be coming to the fore as far as Tata Tech is concerned. Concentration, too much concentration on the top 3 or 4 clients is one of them, definitely. Just because we're talking about the tech pack, wanted to bring in Persistent, because Persistent numbers came in as well. Profits have missed estimates, so not as exciting, definitely, and not an up move that could be expected. Revenues Q on Q were up 5.7%. EBIT was up 2.5% at 384 versus 375. EBIT margin was slightly compressed, 14 versus 14.5, and net profit was down 2.9%. One theme or thread that you could pick out, and this is echoing for Persistent as well, in the entire IT pack, is what's happening with BFSI. So BFSI sector has boosted results for Persistent as well. The segment has grown 5.9% Q on Q. So your banking and financial services are finally beginning to come back. So that can be seen. The software segment was flat. Healthcare and life sciences grew about 16.5% QOQ. In fact, there was one more, I think, IT company, LTTS, which you wanted to talk. Maybe we'll finish that off and then get back to you.
Let's do the IT circle.
So we just do the whole IT circle up front.
So Infi, Persistent, Tata Tech, and LTTS. So, the ER&D stocks haven't done well. Persistent and Infi have done well. Goldman Sachs, in fact, cut the target price on Tata Tech as well. But LTTS, interestingly, the numbers did leave a bit to be desired because relative to estimates, LTTS numbers were lower. So revenues down 3% at 2462. The estimate was 2532 crores. EBIT margins 15.6. Estimate was 18.9. PAT lower there as well. And I think the Nuvama note makes a very interesting point that while the management has attributed it to various reasons, but the company stuck to the guidance. And that makes the ask rate over the next 3 quarters very, very stiff, which Nuvama believes is a bit of a stretch. Or we're not talking to management today, maybe on Monday or Tuesday, reckon the stock could see some punishment in the session today.
Yeah, it was weak to say the least, but of course, if the management comes out and paints a pretty rosy picture going ahead, the street may want to take heart from that. And I think that's what's happening with a few of these companies. The commentary is positive. Asian Paints as well, while earnings were weak, the commentary was very promising. Again, something what we saw in the last quarter as well. I'm going to quickly go into a little bit of the consumption play and shopper stop numbers. So I guess with the household spending dropping, money is clearly going into financial assets as opposed to being spent on discretionary goods, and reflective in terms of what Shopper Stop has reported with earnings. Their earnings were lower than what the street was expecting. There's a very clear decline. EBITDA was down 17% to come in at 143 crores. Margins have declined. Huge hit on margins, coming in at 13.4% versus 17.3%. But the big takeaway is the loss that they've posted of 23 crores versus a profit of 14 crores. So it's not just a drop, but they've now moved into a loss-making or become a loss-making company. So they've gone into the black from the way we see it. The reason that they've given, like everybody else in the same space, has said that the heat wave, elections and inflation was the reason why their numbers have been impacted. Their total expenses have also increased more than expected. Now, this is interesting. They've done lesser revenue, but their cost has gone up. It'd be good to understand from the management why they've seen such a significant jump in their expenses. They've said, though remain positive, management remains positive about the outlook. They said they're going to continue to focus on premiumization, and they're going to shut down stores that are unviable for cost rationalization. They've also talked about an expansion plan of about 45 crores in the current financial year. But all in all, weak earnings, but the outlook.
I'm just wondering how the heat wave impacted.
I have no idea. I mean, you'd imagine in an AC. I believe, and I think this is true, a lot of people in smaller cities probably go to malls because it's air conditioned.
Yeah,
Shopper Stop has air conditioning and a coffee apparently.
Yeah. No, so I don't quite buy that.
No, I think it's a great excuse these days.
Yeah, everything is heat wave.
Yeah,
so,
and elections. Because they didn't anticipate elections happening. It does happen every 5 years, but
no. And what would be that impact on people having the propensity to go and buy? No one's coming to your particular store. That's the fact.
I think in my head, all this money that was getting spent on shopping, and I think we have Niraj would 100% agree with that, because every time you want to buy coffee, he says do an SIP. So these are the sort of people who are not shopping anymore and doing SIPs.
When is the last time you went to a Shopper Stop and didn't buy online? Think about it.
That could have changed.
So, yeah, lots of things changing there.
So, Shopper Stop week numbers. What else on your list?
Tanla, because that stock buzzes.
The earnings don't even matter with this one.
Once in a while, yeah. But earnings aren't great. Revenues are flat. EBIT is up 20.6% though. EBIT margin has improved to some extent. Net profit also up. So I would say, okay. The big number though is that their customer count is up by 49%. So you might see a good move on those counts, not just by the numbers, because it's an interesting business, right? It's an omni-channel, multi-marketing, communications agency. So, I mean, all of those, bringing your product or a employer's or a company's product on your WhatsApp channel, etc. Their product penetration is improved to 2.37 from 2.17. New customers added on WhatsApp have gone up 19%, and OTT contribution has jumped massively. I think this is going to be the key figure as far as Tanla is concerned, from 7.9% to close to 20%. So that's a massive jump. The digital platform gross profit has also gone up. CEAT is the other one I'll talk about. Tire stocks were in vogue. Their numbers have come out, so just a quick word on that. Revenues are up, but EBITDA is down, EBITDA margin is squeezed. This was expected. I would say weak quarter, in line with expectation, because the raw material basket has increased compared to Q4 of FY24. So quarter on quarter, just cost inputs have gone up. That's resulted in a gross margin contraction of 306 bips. EBITDA margin was also impacted by higher other expenses, led by increase in marketing expenses, and year-on-year margin also contracted due to increase in marketing spends. Debt has increased slightly. Higher working capital has contributed to that, but replacement segment is seeing a healthy volume growth while OEM growth lags, and this is the story across your tire companies as well. So you might see a bit of an impact on CEAT today.
Okay, a couple of stocks, the cement names, both of them had good margins. So I think just quickly highlight them. Dalmia Bharat, I mean, both companies had flat revenues, but the margin number for Dalmia Bharat cement was 18.5 versus 16.9. The estimates were 15.6%. So that's Dalmia Bharat for you. Maybe the margins showed up the company. There's an exceptional loss, which is why PAT was flat. In Sagar Cement's case too, revenues were flattish, up 4%, but EBITDA margin at 8.3 versus 5.7, as a result of which the net loss came off a bit as well for the company. So both of these stocks, EBITDA margins looked okay. Watch out for that. Couple of we should tell a couple of key brokerage notes. So there is a Citi on ONGC, which is a very constructive note. They've raised the target price to 370. So you need to watch out for that note. You need to watch out for Dalal and Brocha's note on Protea and eGov. The target price is 30% higher. So Protea and eGov is the second one from a brokerage note perspective, which you want to keep an eye out for. And guys, there is a BNP Paribas note on AI engineering. What stood out for me from that note, I mean, they've initiated with an outperformer target price of 4883, structurally well placed for the high chrome shift. But the key line is that they're saying that the profitability of AI engineering is 2 to 3 times EBITDA per kg terms better than competition. And therefore, they have a moat of a low cost service, which is very difficult to replicate by the Chilean competitor who is the market leader currently, and therefore they are very constructive on AIA despite the numbers and despite the trade actions which could be key risks. So very interesting note, and could be interesting to see what AI engineering does in the session today.
I'm going to just add a few earnings, and we saw last week that Bank of Maharashtra reported earnings last Friday. Numbers were phenomenal. And today we've got South India Bank, again, very good earnings coming in from South India Bank. Profits were up 45%. So this is going to be one stock to watch out for this morning, to come in at 294 crores versus 202. Net interest income also increased 7.2%. Gross NPAs have remained flat in this quarter. And your net NPAs have actually fallen Q on Q to 1.44 versus 1.46. Another quick one, not too much in terms of earnings, but we'll still mention it, is CIE Automotive India. Profits increased marginally while revenue has dropped about 1%. So those are the two more, but I believe there's Rallis India. Those numbers were rough.
Rallis was bad. I just want to talk
GSW Infra was also mixed, I think.
Mixed. HAL I want to talk about, even though defense is completely out of favor ahead of the budget, but HAL has signed an MOU with the Aeronautical Development Agency for the completion of the light craft combat aircraft MK2 development. So the completion will lead to operation clearance for a value of 2,970 crores. So that's a significant and tangible order. So just HAL I wanted to talk about. We'll take a very short break. But before we go into the break, I just want to highlight one part, because we're talking about budget, what's going to happen in budget. The theme is for consumption and boosting consumption completely. Just want to put out these 3 or 4 points from the RBI July bulletin yesterday, which I found interesting. Because the message is giving is that we need to brace for sticky food inflation, which was the big pain point for the CPI and WPI. It says monsoon forecast augurs well for further progress of Kharif sowing, but tomato, onion and potato prices will be seeing sequential upticks in July. So you're going to see this continue. Too long a period for food price shocks to be termed transitory. So that means it's here to stay. And recent halting declines in inflation readings have to be seen as a work still in progress. This is the big focus. And this is something that Sanjeev Puri of ITC said to me yesterday as well. When I asked him, is he actually seeing green shoots of rural recovery? Listen into that, and then we'll get into a quick break and come right back.
We are certainly seeing some green shoots. And I would say not just us, this is the commentary you've heard from several players in the industry. There are green shoots definitely, visible. But I think the question really to answer is that how do you put rural into a much stronger trajectory? And as I said earlier, the challenge has been on account of weather events. Fortunately, the monsoon, the predictions so far are good this year. So hopefully the crop should be better. That will provide some impetus to rural India. But on a sustained basis, I think the issue is about how do we build resilience in agriculture? How do we create more non-farm jobs in rural India?
Welcome, this is India Market Open. We're taking stock of the futures and options space at the moment. Yesterday was yet another day where we saw the Nifty make a new lifetime high, largely on the back of the IT space, which actually continued to advance. And on the back of that, we actually did see the Nifty at least, well, move up and make new life highs. But the question really is that what does that mean? We have seen more longs being built into the system within, given the open interest did increase by another 5%. As far as the July futures are concerned. The Bank Nifty, on the other hand, which did advance by around 0.5%, actually didn't see any addition and saw a little bit of unwinding coming through as well. Well, moving on, when you consider the options market, as we move into another week, naturally we are going to see a little bit more of support around the 24,500 mark, because that's where we're seeing a little bit more accumulation around puts. On the higher end, of course, well, at the moment, considering we may test the 25,000 mark, if not today, then potentially on Monday or Tuesday, well, that remains an important zone, because as you can see, there's a substantial amount of calls being written out there already. So if we actually see the Nifty take this level out, there could be a further up move from there on. That said, when it comes to stocks, it was a mixed year of trade, but more losers than gainers. And while we did have longs in India Cement, Muthoot Finance, India Mart, Intermesh, even in terms of stocks, we saw unwinding. Well, there was long unwinding for Vodafone Idea, L&T Finance, as well as something like a Tata Chemicals. But given the current circumstances, what are the stocks that can perhaps be put the spotlight on? And what are the option structures that we can work around with? But for that, we have Avni Bhatt of GM Financial, who is joining us on the show. Avni, good morning. Thank you so much for joining in. I reckon that the first stock on your radar is Bharti Airtel. Can you tell us about your assessment of the stock and what sort of an option structure you're deploying here?
Good morning, Agam, and a very good morning to all the viewers as well. So Bharti Airtel has closed above the weekly resistance of 1465 and on reasonably good volumes, and after a 6 weeks of consolidation phase. So there's a positive RSI crossover also seen, along with a lot of short covering in futures, almost to the tune of 2% in a single day. So that's a good, very good structure technically as well as on derivative parameters. So we believe that Bharti Airtel from here on should see a very good move on the upside and a very quick move. And that's why we recommend buying a call option of July 1500 call at around 11 rupees and keep a target of 28 for the call option and stop loss of 2. So the risk reward here is very good. And my second stock would be from the oil and gas sector, which is BPCL. So BPCL again has closed just above the weekly resistance of 317 and on very, very good volumes and after a 15 days of consolidation. So if there is any stock which moves up and crosses the resistance level after a phase of consolidation, the up move is pretty quick and huge. And we've seen a massive 4% of short covering also in the stock. The shorter moving averages of 10-day, 20-day and 50-day moving averages are trading right below the price action. So they'll keep supporting the up move. And that's why we recommend BPCL also a vanilla call option, 325 call option for the July series at around 5 rupees. And the target can be, it can be a potential doubler. So the target would be 10 rupees and the stop loss can be kept at 1.5.
Okay, so well, two calls coming in here, well, based on Bharti Airtel as well as the other one is BPCL. And do remember that BPCL will also react to earnings coming in over the weekend on Monday. So naturally, we will have that impact as well. But Avni, if you just zoom out and very quickly, if you can give us your overall sense of the benchmark, that is a Nifty 50. How are you reading cues here, and how are you approaching this?
So if you actually see the price action between Nifty and Bank Nifty, there's a huge divergence. Nifty is making newer highs every day, while Bank Nifty is still languishing within the 52,000 to 53,000 price band. And so now the game from here on is whether which index will catch up with the other one. And hopefully the entire data set for Nifty is pretty positive. Although some of the technical and derivative parameters are highly overbought, Around OIPCR is around 1.33, which is close to the resistance, while the RSI is also trading above 70% for a pretty long time now. Although there is no divergence in the RSI along with the price action, but it's pretty overbought. So there can be some cool off from the higher levels. Yesterday's up move up to around 24,800 has been a very good move. No signs of shorting yet, but there can be some bit of cool off. So as far as the trading strategy is concerned, I have three scenarios here. If at all we see a gap up opening close to around 24,900, we will not chase the gap up. I think you should get into the profit booking mode and stay light over the weekend. If at all there is any kind of a dip close to around 24,650, plus or minus 20 points, then I think it becomes a very good buying opportunity with a stop loss of 24,500 on the downside, and we can obviously target around 25,000 on the upside. And if at all it's a flat opening, a neutral opening, then I think you should wait for the first 1 hour of the trade to see where how the markets are settling down and which direction is it in a mood to go.
Okay, well, in interesting way of looking at things, certainly, and I reckon that at this point in time, Avni is suggesting caution considering the heady levels at which the Nifty are currently trading at, and of course the key mark to keep an eye on in today's day of trade specifically is of course 24,900, and you can perhaps base your decisions based on that particular level on achieving it or no. But on that note, Avni, taking a moment to thank you for joining us and taking us through your views on the markets, and of course giving us a couple of trading ideas to work with. With that, it's back to you all.
Thanks for that, Agam. That's the market texture this morning, and of course a few trading ideas as well coming in from our guest. But the stock of the day will be Infosys. The ADR closed with a gain of nearly 9%, and it seems like it's all going to be off to a great start this morning. Well, as Infosys, the reason for the excitement is that they've raised their FY25 revenue growth guidance to 3 to 5%, and they expect operating margin to also grow at 20 to 20% in line with the industry. Here's what the company leadership had to say about the demand landscape and the current pricing environment.
Sir, could you give us a broader sense on the demand environment when it comes to other regions than Americas? And what is happening on the pricing bit? What has changed since the last quarter? What gives you the confidence in terms of like upping the guidance?
So on the, I'll go the first point on the demand environment. In other regions, so what we see, which we've continued to see, good growth. First, sequential growth was good across all the geographies, but we see good demand in this sort of an environment in the European market where we've had good traction, and we've also had some of our large deals ramping up in that environment. Equally, in what we see in the US or the North American market as well. So both of those we're seeing good traction on. Jay should also give a little bit more color on industry later. And the second point, go ahead, Jay.
Sorry, what was the second point?
The second point on the pricing.
So pricing environment has pretty much remained stable. But if you look at, again, one of the pillars of Maximus is value-based selling, where we've been able to make an impact, which has helped us, improve our overall pricing. But overall environment has continued to remain stable.
That's a very forward-looking, positive management coming in from Infosys. We have with us Kush Bora now, founder at kushbora.com, joining with his view on the markets and his top trades. Kush, good morning. Thanks for joining in. This is interesting, right? We've been defying the world, gaining, making new record highs on small wins, but the breadth of the market is a little unsettling at this stage. Would you be brave enough to consider taking a long position on the index? And also, with all this talk about 25,000 inside, do you think it's likely ahead of budget?
Hi, Samina. First up, a very good morning. Well, in all practical sense, these milestones, so to speak, are mere numbers at the end of the day. As you rightly pointed out, the Nifty could perhaps go ahead and hit 25,000 at the start. Who knows? But at the end of the day, if the investors aren't really making money, then that's their reality. That's the reality. So I do think that this traction could continue. the confidence comes from the fact that, in fact, that we've been seeing this for the last month and a half, where every time the Nifty moves up 100 points, the support zones start to kick in, where you see a lot of put bases being added on. So, till the time the market really on the price action front gives you that kind of a crack, no point shorting. You might as well continue riding this wave. But yes, if you do get, let's say, about 100 or 150 or perhaps a little more, as a gap up, I don't think, you should go out and chase that. 25,000 is anyway a psychological mark plus some call option writing there. So the risk reward ratio won't favor. If you get a flattish start, then perhaps, you could consider, going long with, let's say a stop loss of anywhere close to 24,600, 24,650 for targets of 25,000, 25,100.
All right, so Kush, we'll wait for that excitement to build if it does. Now let's talk about the top picks. Let me guess, are you looking at IT or not today? Or is it all going to be about IT?
Certainly not, I will say. And the reason certainly comes in is because, see, a lot of these stocks had already moved, before the results came out. And a lot of these stocks are, showing those big spikes after the results. So where do we go from here is a bit of a question mark. Some of these stocks are very close to, resistance levels. TCS, while it's up from, the day it actually, declared its numbers, but, it did see some sort of a profit booking. So Infosys today, if as the ADR is suggesting, does indeed move up, 8-9%. I mean, do you go long from there? No, I don't think so. So I'll wait on that. Anyway, Infosys was actually in the oversix territory on the daily chart. The RSI was over 80. So for a stock like Infosys, RSI more than 80, I think, there are some alarm bells there. So this gap up perhaps should be taken as an opportunity to, take some money off the table from, Infosys as a trading bet. Now, as far as the calls go, two of them, the FMCG space is doing well. New names keep, cropping up every day. Yesterday it was Tata Consumer. Before that, Colgate. Today we've got Bajaj Consumer. It's seen a big spike. The stock, if you see the trend from the last month and a half, is clearly on the rise. So as a trading bet, if someone wants to consider, 290, 300 are the near-term targets. 270 is where you place your stop loss. And given the slightly cautious outlook on the market, I today have one more short call, which is Jindal Steel and Power. It's been seeing lower lows formation for a couple of weeks now. The momentum indicators also suggesting further downturn. So for the July futures, 970 and 950 are the targets. 1010 is where you place your stop loss.
Kush, we saw Bank Nifty do a little bit of eking out some gains in trade yesterday. And it's looked a lot more constructive since maybe Monday, Tuesday than it has in the first 10, 12 days of July. Do you feel there could be a long trade opportunity on Bank Nifty today?
So, Samina, I am actually quite constructive on Bank Nifty, but how Bank Nifty is playing out is that it's been respecting a band. So on the downside, you've got this 51,800, 51,900 kind of zone where it's not broken below. But on the upside, you have 50,800, 50,900 kind of zones where it's not broken past. So for me, this is a range play right now. If I do get any kind of dip towards that 51,800 mark is where I will consider long position, or as an alternative. If today we get an gap up opening above 52,800 and we sustain there for 15-20 minutes, maybe half an hour, is when I play for the 53,300 mark. So it's a bit of a conditional play. I am a little constructive on Bank Nifty compared to Nifty, and the only reason is that the risk reward ratio, if it does move closer to the support zones, is actually way more favorable than the Nifty. So slightly more constructive, but maybe closer to 51,800, or if we go past 52,800 for, let's say, and sustain that for another half an hour.
Okay. Amongst other things, I think stocks that we should watch out for, like we said, cement stock should be in focus. There's also this note that has come in on airport tariff revisions. Adani Airport has done it for a couple of its airports, but I think therefore it brings GMR airports firmly in focus. So I'll watch out for that. And watch out for the cement names, as we said, on the trade setup as well. Dalmia Bharat as well as Sagar Cement, because on both of those counts, the margin performance was very strong. Now, Kushbora, I wonder if in the scheme of things, because yesterday you had a sell call, if I'm not on Ramco, what about a Sagar? What about a Dalmia Bharat? How do they look on the charts? These two specifically.
So Sagar Cement, we were fairly constructive on for a while. The only thing is that the price action really hasn't come about. It's made a couple of attempts to move past the 270, 280 mark, but then fizzled out. So it's trading in a band, nothing too constructive just yet. So I will hold on any kind of fresh buying in, let's say, a Sagar Cement. Dalmia Bharat, I think I'm having some issue loading that chart, so I think I'll have to skip that one. I'm sorry.
Well, watch out, watch out for some of these. The other thing is, Tamanna, we were doing this conversation around banks, right? But I think, and you made this point about the RBI bulletin, and I was reading what Vishy was saying yesterday and what the City Note said today, that the revenue neutral rate that they're talking about, and what does it imply? Does it mean that a rate cut expectation, despite the fact that Q2 inflation, despite sticky food inflation, might be a bit lower than Q1, but is it therefore that the rate cut conversation is firmly out of the window for the current calendar, and does that hamper the performance of banking stocks because of that precise reason? I think that's an important ponderable over the course of the next few days and weeks.
So most estimates for the rate cut in India have been pushed to April 2025. So 2024 is just out of the question, and keeping in mind that the Fed might still cut in September. So, but I would just caveat that by saying that higher rates have not really hit India growth in any real which way. So
just that, I mean, when we are on a capex drive, and if private sector capex has to come in, I mean, lower rates might just maybe help.
Lower rates always help, definitely. But we're focusing on IT this morning, and it's honestly, it's the big story. Are we seeing a turnaround, a comprehensive turnaround for Indian IT companies? Trip Chaudhary is with us. He's MD Global Equities Research. Trip, very good morning to you. Where we're sitting, good morning. And great to have you on NDTV Profit and get your view. Now, we have, I would say, sufficient data in to make some assessment of whether there are green shoots coming in for IT companies. We've seen Infosys. Street seems to have or would likely like it. TCS as well. Let's start with your take on Infosys specifically before we come to the big question.
I think if you look at Infosys numbers, it clearly shows that two secular trends are being formed right in front of our eyes. The digitization of every operation has now gone over and beyond to include AI, artificial intelligence. But remember, AI and machine learning were really not gaining traction for the last 2 years because it was all based on large language models, which were truly expensive, and enterprises never felt comfortable spending so much money. Over the last 6 months, the trend has shifted from large language models to small language models, where the cost of computation has fallen by a factor of 1,000. That has given rise to the new digitization of various operations to make AI and small language models integrated into the solution. And when you look into that, this is a sweet spot for all Indian IT services companies, because right now the enterprises are rushing to make sure they have a very compelling AI strategy. Just like 10 years back, you had to have a mobile strategy. 5 years back, you had to have a cloud strategy. 3 years back, you had to have a digital strategy. Today, if you don't have an AI strategy, you won't remain in the business for near future. So the strength of Indian IT services companies is helping many of the companies to get into the AI ecosystem and play this new era of artificial intelligence based specifically on small language models, not the large language models. That business has plateaued.
Okay, so now that's an interesting perspective, that there is a sweet spot for Indian IT companies, because that was the question, right? In the whole Gen AI race, where are the Indian IT majors? And you're saying there is definitely a space there, and to give those enterprise solutions. Let's then rank them. Who is best placed? And then let me come back specifically to Infosys once again, Trip, because that's the story this morning that the Indian markets are looking at.
I think if you look at the companies who have been very proactive, remember, you have to keep hitting and trying, and by doing that, you build an institutional knowledge. And if you never tried, you would never be where you are today. So I would say in terms of Indian companies, I'll put both Infosys and TCS at the top. But if you take overall, I would say Accenture would be number one, and Infosys and TCS would be close second.
Trip, good evening to you. I know the conversation at your part of the world is about who will be the Democratic candidate. The conversation out here is that can ER&D also do what IT services is doing, because those stocks are a lot more expensive than what tech services are, and the results thus far from Tata Tech, from LTTS, etc. haven't been that great. I don't know if you got a chance to look at that, but if you do you have a favorable view on the ER&D stocks or not quite?
I would say we have to lead from services. Remember, why IT services companies are doing well. Whenever there's a technology disruption and people need to have an educated sale, like it is education-led sales, like if people not here waiting and saying, give me, I need to be an AI company. People are saying, I see this technology, how does it help me? So it is more of a consultative engagement, and you start by being a credible enterprise advisor, which Infosys and TCS are, and then it follows through to the real technology providers, which is a second order beneficiary. The first order beneficiary is definitely IT services companies and the solutions that they bring to the market. And for the role that these technology companies have to play is they have to have a very strong IT services arm with it, or be partnership with them, because without that, because they won't win the customers.
Okay. Okay. So Trip, sorry, just to get it clear, you're not constructive on ER&D, right?
As a second order of benefit.
Second order.
Yes.
Okay, fine. Okay, but
yes.
not principal.
That is, first it's always a sequence. First,
got it.
It's led by.
Got it. Trip, but this is heartening to see, because until 3 months ago, obituaries were written about what AI will do to Indian IT, and now we're seeing that positive view for Indian IT stocks come in. So great to know that. Thank you so much for joining us this late. Really appreciate your time.
Thank you. No worries.
That's the view from Trip Chaudhary, and it's clearly a turnaround. Sometimes, charts tell you stories which maybe fundamentals at that time might have seemed a bit fuzzy, but we're making it an all-take day, because in about 5 minutes from now, you'll also hear from Tata Technologies about what went right or wrong that quarter. But Hemang Jani joins in with his view. Hemang, it's too much of tech, but what to do? It's tech all around. 2 IT service names, one IT service name, 1 product name, and 2 ER&D stocks. 4 have come out with numbers post-market hours yesterday. I know Infy would have stood out. Beyond Infy, Hemang, what is it from a Tata Tech, from an LTTS, from a Persistent, which stood out for you?
So yes, tech has been hogging the limelight, and for the right reasons this time. And of course, partly it is because of the kind of numbers that they've delivered, the growth outlook, and more importantly, certain verticals like BFSI. The kind of commentary which is there is very reassuring. So I think people would want to review their allocation to the IT space in general. And the ones that stood out for me clearly was, of course, apart from Infosys, HCL Tech, I do like, though the numbers were not that great. But if you look at the, valuation and the possible growth, that one can really look at. Within the large cap space, I think both HCL Tech and TCS, are looking quite compelling. And when you look at the mid-cap companies, of course, Tata Technology is something that the numbers were not at all impressive. And I think it's more of a hype stock with the Tata brand. But when you look at the business model, the growth, it's not at all inspiring. So would avoid that. And I would go with something like LTI. I think LTI is something that we like in terms of numbers and growth both.
Hemang, good morning. Tamanna here. We've been speaking for quite some time on whether IT companies are turning around, etc., and very long-term kind of views. I think we should do a little bit of a rapid fire this Friday morning on what our viewers need to know, right? Buy, sell, or hold. At the end of the day, that's the question. I mean, look at all of the brokerage calls and Infosys. So let me start with Infosys for you, Hemang. Buy, sell, or hold?
Hold.
Hold. Okay. Infosys is a hold. TCS?
TCS is buy.
Okay. Infosys hold, TCS buy. LTI Mindtree. I'm liking this game. I think we're going to make it a feature. LTI Mindtree?
Strong buy.
Strong buy. Persistent?
Hold.
Okay. Let me take Kush. I think you want to come in on this game because, at the end of the day, that's for an immediate call. I think we should give that input to our viewers. Infosys is a buy right now. Buy, sell, hold.
Infosys is a sell, assuming a gap up opening.
Okay, this has to be rapid though. TCS?
TCS is a hold.
TCS is a hold. LTI Mindtree and persistent?
LTI Mindtree is a buy and persistent is a hold.
Okay, Hemang says strong buy for LTI Mindtree. Do you want to add that adjective of a strong buy?
Why not? I see a clear run up until about 6,100 from a technical standpoint, and then that's quite a run. So yeah, I'm a strong buy.
Okay.
Just to add to that, Tamanna, after that emphatic, certainly not, on IT stocks, once popped up on my radar, which is Tata Tech. I think, there were some brokerage notes also that came out yesterday or day before. So that's the one that you want to add to the list as well.
Tata Tech, I'm going to add because we're going into the management conversation right now. Very quickly, Kush, Tata Tech, buy, sell, hold.
Sell.
Hemang? Sell. Sell on Tata Tech from both. But anyway, let's listen in to what the management is saying. They've had a rough quarter. Warren Harris has been speaking to us and telling us what the path ahead is. Markets have also opened, the pre-open rates. You'll see that on your screen. But let's listen in to Warren Harris.
The numbers from our perspective are relatively solid and show, I think, great resilience. If you look at the split of our business, we have a services business that's about 80% of our business and revenue mix, and we've got a technology solutions business that is 20% of our mix. Within technology solutions, we have a value-added reseller business that is very seasonal, and so much of that business is discharged in the second half of the fiscal year. We undertake a series of renewals for many of our customers, particularly in the United States. So that seasonality typically sees about 40% of the business delivered in H1, 60% in H2, and so the numbers, the decline that we saw sequentially is very much in terms of what we've seen in the last 20 years, and was very much in line with expectations. As far as services are concerned, what's encouraging for us is that the first quarter was the last quarter of the transition that we've seen at VinFast. You might remember that we've completed the development of 2 electric SUVs for VinFast. And this time last year, VinFast was our largest customer. And so what's encouraging for us is that we've backfilled that revenue, and we now have a solid baseline from which we can drive consistent quarter-on-quarter growth for the rest of this fiscal year.
Sure, sir. But talking about the services segment, which accounts for almost 80% of your revenue, saw a quarter-on-quarter decline. So do you attribute this to the global EV slowdown, is it?
No, we attribute it to the fact that we've seen runoff of the business, the revenue that we've done at VinFast. We've also seen a couple of large projects who were slated to kick off in the first quarter. We didn't see those projects get started until the end of the quarter. So that's impacted a little bit of the softness that you've seen, but predominantly the sequential decline was driven by the the completion of the runoff at Winfast.
Sure, sir. But sir, let me move on to talking about the MOU which you have signed with your arm to develop the automotive software solution. So what kind of margin impact, any kind of margin dilution from this kind of deal do you see, number one? And also about the hiring, since this is a big one, what kind of hiring do you see going ahead related to this kind of deal?
Well, if you look at what we're focused on through the partnership that we've established with ARM, it's really providing solutions to the software-defined vehicle and product requirements of our customers. You know, as the mobility industry pivots from its dependent upon internal combustion engines to electrification, connected, autonomous, and shared. Software is increasingly defining the competitive position of those vehicles or of those products, and you know, no one company owns the entire technology stack that will deliver software-defined solutions for the customers that we work with, and so we're having to build an ecosystem of partnerships and alliances that allow us to configure solutions for the specific requirements of our customers. We've been very, very pleased with the relationship that we've established with ARM. They are clearly going to be a key player, not just in automotive, but again in the entire mobility sector. And we're very excited about the growth opportunities that represents. And we certainly don't see any margin deterioration with regard to the revenue that we drive through that relationship.
So, sir, do you expect this revenue growth to improve in the coming quarter? Is it, Mr. Harris?
Well, we certainly expect now for the rest of the year, now that we're through the transition at Winfast, we certainly expect sequential quarter-on-quarter growth. Our order book is strong. The pipeline continues to give us confidence that we can really kick on from here. And drive the type of growth that's expected of this sector, and is consistent with the macro demand that is clearly in and around the sectors that we are focused upon. So, you know, we are cautiously optimistic about short, medium, and long term.
Okay, that was Warren Harris talking about the quarter gone by and the one ahead. Stock is about 0.5% down, but this morning let's just quickly look at what's happening to Infosys in the pre-open session, and that's really exciting. Infosys up about 5% in the pre-open session. We'll have to wait for those rates to settle and see if that really carries on to the opening rates for the company. But the flavor continues to be firmly IT. Let's look at TCS. Let's look at Wipro. Some of the other stocks that are really racing through today. TCS is tepid, nothing much happening there. Wipro is up about 1%. I want to pull up Sterling and Wilson. Now, this is a stock whose numbers, their Q1 numbers, have actually been very, very positive. And we didn't really mention this in the pre-open, but this is the reason you're seeing a 4% uptick, possibly. Net profit of 5 crores in this quarter versus loss of 95 crores year on year. Revenues are up 78% at 915 crores, and EBITDA profit of 25 crores versus a loss of 37 crores. So a bit of a turnaround story there for Sterling and Wilson. That's why that stock's doing well. Tanla also doing decently. It was on our watch list and the numbers were good, 2.5% up. So those are some of the ones that are moving this morning. Kush, let me come to you on anything interesting that you're spotting in the pre-open session.
Well, as I said, Tata Technologies, this one's actually been consolidating after a big move. So I think it's getting ready for, some more upside. I think from a near-term perspective, I think 830, and then once that is taken out, you're looking at an 870 also. So positionally good buy. The overall trend is quite positive, and it's gone there with fair bit of breaks along the way, not like a one-sided rocket up move. So I think this is a fair trend or a fair stock that you can get into from a positional standpoint. 870 being the target. Stop loss for this one comes in at 770. So risk reward ratio also squarely favorable.
Okay. Okay, the pre-open rates are now just about to settle in, and no, we're not quite within sniffing distance of 25,000, far from it. And I think, and this is, by the way, I think this is despite Nifty IT looking okay. So bear that in mind that it is. There are a lot of other stocks beyond Infosys which are pulling the index lower. Life insurance stocks, by the way, today seem to be taking a bit of a pull back, Tamanna, after a number of days. There is weakness in Kotak Bank for sure. There is weakness in some of the commodity names like Hindalco and others at the end of the pre-open session. So you have to bear that in mind, that IT is one game which is helping shore up the index, Infi, Wipro, HCL Tech, all of them. But there is a market beyond too. You know, I think, Himang, coming on oil upstream and particularly ONGC, because this one is not seeing any sunset. Yesterday, Oil India saw the first sign of a pullback too, but ONGC is continuing its gains unabated. It's had a very strong move in the last few days. It is very volatile, dependent on oil price moves too. If you were tactically long, Himang, would you stay long or would you take some chips off the table from oil upstream?
Very positive view. So not only I will remain, positive, but if I were to also, look at adding positions, I will be very comfortable doing so. Primarily because it's coming out after almost about 8-9 years of consolidation. Valuation wise, not stretched. You continue to see the growth in the gas volumes. The pricing side, the government could support them, a 4.5% kind of a dividend yield. So the entire market, if you see, we all look at the valuations. There are very few pockets where you will be able to see that comfort. So I think ONGC would be surely one of those, and along with that, maybe some of the other, gas utility companies where you can be very comfortable when it comes to valuations.
Okay. Well, so Himang Jani is saying he's comfortable adding an ONGC as well at the current levels and the current valuations fundamentally. Harsh Johnson with a brokerage note of the day, because I believe ONGC features in one of those. Harsh, are there two or is there one? Very quickly.
Well, to Niraj, let me first start off with ONGC City maintaining its buy rating, but what it's done is it's upped its target price quite drastically from the 315 earlier, now at 370. 11% upside from here. Let me quickly enumerate why they've done this. One, they've increased the EBITDA multiple from 4 times to 4.5 times. What they've also suggested is they're seeing improved outlook in both oil and gas production as well as realizations, both of that to likely drive that re-rating on the EV EBITDA that we've just seen. Also, in terms of FY26 earnings, they've hiked that by 9%. And they've largely raised the target price also from a perspective that they're marking to market the value of ONGC's investments. And that has increased a little bit, and that also has led to the slight increase in the target price. Switching focus, the second one, Zentech and ICICI Securities is the second note in the last 7 to 8 odd trading sessions that we've seen on Zentech initiating coverage. Very strong target price, again 2,000 rupees. Stock hasn't run up since the last initiating coverage note, and therefore this one is also in focus. First off, IP based business model backed by in-house R&D, very positive. Products are largely 70 to 80% in-house, and therefore good deep moat. In terms of other moats as well, lower reliance on third parties as well as insulation from fluctuation in raw material prices. That too helps the business. Overall, significant regulatory tailwind coming in the defense sector, especially in simulations. We've seen Ministry of Defense implement a comprehensive framework aimed at implementing simulation-based training across military domains, and Zentech is at the forefront of that. Size, in terms of opportunity size, 15,000 crore. The top line is less than 1,500 crore. So large opportunity, significant over the next 5 years. It's entering a very strong earnings growth zone. Currently, they're valuing it at 45 times FY26 expected earnings. This, of course, government contracts largely is what is driving this, and it's not recurring contracts. It's over every year, and it's order based, and therefore that risk is on the horizon. But nonetheless, 2,000 rupees, 48% upside from here on Zentech.
Okay, so Zentek, ONGC in focus. I think another company we should quickly talk about is RIL. Big numbers out today, and while we've been obsessing about IT, I don't know if the street will really make up its mind before it sees Reliance numbers. And Hemang, I just want to come to you for a quick view on what you're really expecting this quarter from the heavyweight.
So Tamanna, I think the quarterly numbers are not going to be any major in terms of positive surprise. It's going to be a subdued quarter when you look at quarter, and primarily because oil and gas will be okay. The refining margins, we have seen a bit of a softness. Geopart, the real impact of the ARPU increase will be there maybe next quarter onwards. And retail is also steady state kind of a business. So no positive surprises. But I think the stock has basically stabilized and you're seeing an uptick there. So I would be comfortable holding on to Reliance, but not expecting anything major in terms of positive surprises.
Okay, so that's the view on RIL coming in. Just less than a minute to go. Kush, last quick call.
So Tamanna, Mrs. Bector Foods, this stock starting to look very attractive. Positionally, 1550 would be the target, and on the downside, 1420 as a stop loss. So could be a positional bet, but a recovery seems to be underway on this one.
Okay, so Mrs. Bector's is the top call from Kush Bora. We played a rapid fire with Hemang Jani already on his stocks. Kush, I'll ask you one more time though. For somebody who was long Infosys and she or he is seeing this 5% uptick on open today, should she or he take some money off the table of an Infosys trade or stay long?
Take money off the table, enjoy a good weekend.
Well, that was the advice that was given on, I believe, HDFC Bank, and proved to be prescient. Could it be the same for Infosys as well? I like the weekend bit for sure. But remember, IT's had a very heady run thus far. So yeah, maybe 4-5%, and then who knows? Might see a bit of pullback too. But remember, fundamentally, Hemang Jani, for example, on stocks like oil upstream is saying that he's happy buying them even after the run up. So horses for courses. Let's get the markets up on the screen this Friday morning. We are going to be slightly different than the rest of Asia. Will be sustained though. Doesn't look like. Far cry from 25,000. 24,819 flattened out completely. Bring up Nifty Bank. Is that sulking? Because I saw Kotak Bank down in trade. Yes, a little bit. As we speak, the Nifty slips, Sensex slips into the red as well. IT should be doing okay. Mid caps and small caps should come up on your screen. Again, IT is not having a rara move. Mid caps, 0.25% lower. Small cap should come up on your screen as well. Flat. Bring up the heat map and show you what's moving and what's not on the large caps. It's infy, but it's not that 7-8% ADR move. 3.5%, that's it. LTI, HCL Tech, Wipro, TCS, marginal gains at that. So a bit tempered, maybe rightly so. A lot of red on the screen. Power Grid, Ultratech, BPCL, Airtel, JSW Steel. It's across the board. Seemingly, the economy-facing stocks are taking a bit on the chin. I really doubt it's got to do anything with the RBI consultation paper, to be honest. It's just essentially profit booking coming in as well. So much unlike what the momentum or the belief was yesterday, we're starting off in the red this Friday, despite, Samina, IT doing well on open.
Yeah, and I don't think we should be complaining. It's been such a good run for the last few days. Global cues were not actually slightly, they were quite weak. So what you're seeing this morning is the Nifty taking a little bit of a break. We're not doing half as bad as the rest of the world. Maybe flat to slightly lower is what we have right now. In terms of stocks, Niraj has already highlighted the big movers on the frontline space, and I'll quickly take you through what's happening in terms of companies across the broader markets. Remember, Elecon Engineering reported numbers that the street did not like yesterday. The stock was your top loser in trade. Today, it's your top gainer in trade. So it's recovered nearly 50% of its losses in the day between yesterday and today, trading with a gain of 8%. So it's a rebound after a big fall that we saw. Well, you've also got Raymond, which continues its upward movement. I'm not sure what the current news trigger on Raymond is, but the stock has been your top. Actually, pardon me, the stock has. Okay, that's down by 4%. I'm not sure whether my numbers are reflecting exactly that. Well, mid-cap IT also doing well. So let's pull up how Birla Soft is doing. Persistent is doing, Info Edge is doing. So those are counters that should be seeing some traction. Birla Soft is up 1.5%. Tata Technology reported numbers. The street may have not liked. Persistent is taking it to the chin, down 6.5%. Weak earnings, and the market doesn't seem to appreciate that. Tata Tech not doing half as bad, but still trading lower in today's trade. L&T Tech, if we can pull that one up, that was again a disappointing quarter for them too. And they're doing okay. The market is not too upset. It's down about 0.5% as we see it. Well, a few other broader market earnings that we are tracking. South Indian Bank, I believe it came just before markets closed yesterday. So maybe not enough time for the stock to react. But like I said, this is a good earning and the stock is up 3%. So Bank Nifty holding on with a few of these smaller mid-cap banks. Tanla Platforms, again, an interesting place. Some may argue that the stock goes through big swings. It's a flat morning on Tanla platform. CIE Automotive India, again, flat earnings. Revenues have dropped. Profit has increased marginally. The stock is down 4% as we see it. CIAT, profits have jumped. Revenues have increased. The stock went into the earnings with a 2% gain. This morning, it's selling the news down about 1%. Apollo Tyres and the rest of the industry sector also seeing some weakness in trade. Dalmia Bharat and Sagar Cement, Shopper Stop, Rallis India. So quickly take us through that as well. Dalmia Bharat is down 1.5%. Sagar Cement, Niraj had highlighted this in the morning. Shopper Stop, I'd mentioned to you, the earnings were weak. The stock is down 5%. And Sagar Cement is up about 1.5%. Rallis India, again, not a great sort of great quarter for Rallis India. The stock is down a massive 5%. So all in all, Niraj, most of the broader market earnings reporting have been met with dismay and disappointment. Rallis down 5%, Sagar Cement looking weak, Shopper Stop down 5%, very, very few gainers in terms of earnings reaction. And even CR, even though the numbers weren't as bad, the sector is taking a knock this morning.
Yeah, and the margin uptick not quite helping those stocks because the volume numbers may not have looked that great. But yeah, broader markets continue to look slightly wobbly for sure. A clutch of stocks have come off. Let me get in opening thoughts from Hemang Jani. Hemang, we've spoken about the large pockets. What about the mid-sized ones? Like for example, cement, right? A margin shore up, yes, but the volume numbers probably not looking the best. We are now in peak monsoon. Are you constructive cement, or would you be slightly bearish on the pocket?
So at least, let's say, from a budget perspective and quarterly numbers perspective, you may see a bit of a positive surprise. Like Dalmia came out with a reasonably good set of numbers. Maybe you will see some numbers, and people may want to, get into the space for the way the budget is giving focus to infra, etc. But purely from a valuation perspective, not too comfortable. I would really want to kind of lighten up positions and look for a better entry over the next, let's say, couple of months.
Okay. Some brokerage calls that came in, remember, the likes of ONGC, there was a brokerage call from Citi upping the target price. That stock is also seeing a bit of a pullback. There is a note from Dalal and Broacha on Protean eGov, and wonder if that stock with that 30% uptick that the note speaks about is seeing a bit of an uptick or no. So that's the second one, up about a couple of percentage points. What's not doing well is Zentech. Despite two notes yesterday from Motilal and today from ICICI Securities, that stock is down about 3%. People seem to have soured a little bit on defense. Kush, opening thoughts, any stock that catches your eye, and a word on either a Zentech or any of the defense names?
Well, I think what market is doing right now is perhaps positioning itself for the budget. Not too many sessions left. So I think, all the froth might be coming off. That's exactly what you're seeing yesterday, at least in the broader markets. Today also, hasn't really been, a great start. So I think, you will continue to see this kind of profit taking for the day, perhaps even, going into Monday as well. Now, as far as, Zentech goes, again, the stock has been consolidating. We did see a bit of a revival come about, but it's failed around that 1400 mark. So until it crosses that, I think I'll be a little watchful.
Sure. Very quickly, I want to talk to you about a couple of movers yesterday. So Elecon Engineering was down massively in trade yesterday. This morning, the stock has done a recovery of 10%. So it's almost recovered 70% of the cut from yesterday. How do you trade Elecon on a rebound? And Asian Paints as well. It's interesting because the earnings, while weren't great, the outlook was optimistic. So this morning, a slight positive bias on Asian Paints, and it did chart a pretty decent recovery towards close as well. Would you buy into Asian Paints betting on a recovery, and Elecon Engineering? I know I'm not sure whether it's in the derivative segment, but nevertheless on the charts.
So Elecon, I think I'll still be constructive on. The 700 mark is proving to be a bit of a resistance today. Also, for whatever little time has gone by, it's crossed that, but not able to sustain that. So once 700 is taken out, I will be constructive. I remain constructive on Elecon. The momentum rather would come after 700 is convincingly crossed. But on the whole, I don't see too much of an issue. The stock was consolidating. It did give that big breakdown yesterday. But as you rightly said, it's recovered almost all of it and then some more. So constructive on Elecon. As far as Asian Paints goes, not really. It's not a trader counter anyway. But if you are an investor, so from a positional standpoint, you could consider buying into this. As I said, the momentum will perhaps continue to be sideways. So 2850 is a positional stop. On the upside, you're looking at a 3100 and then a 3150, 3175 kind of zones. So from a positional standpoint and with a good margin of safety kind of an angle, Asian Paints can be considered as an addition to the portfolio.
Right, Himank, very quickly, a few days ago we saw Bank of Maharashtra report good earnings. Today we've seen South India Bank report good earnings. It seems like there is an underlying hope that some of these PSU banks could actually, beat street expectations in terms of earnings. Do you feel the same? And if yes, would you buy into anything tactically ahead of earnings in the banking space?
Some of the smaller banks have delivered good, set of numbers. But when you look at the ground level, many banks are increasing the deposit rates. And, if you don't see much of an improvement over there, the entire loan growth scenario may not be looking that great. So I would really want this budget as an event to be out and see how the interest rates settle down and then take a call. But yes, if you have a very short-term view where you really want to play, either quarterly numbers or budget as an event, then some of the PSU banks do present opportunity. Bank of Maharashtra, Union Bank, and on the large ones, I think State Bank also is looking quite strong to us.
Okay. Hemang and Kush, gentlemen, both of you, thank you so much for taking the time out and giving us your thoughts. Really appreciate your time this morning.
Thank you so much.
On a note that the markets have been sombered down a little bit, we take a quick break. We try and get in Udmesh Sharma on the other side of the break to understand what he thinks about the current market scenario. Stay tuned.
back. Unmesh Sharma, Head of Institutional Equities at HDFC Securities, now joins in. Unmesh, good morning. It's Samina. Thank you for joining us on the show. Unmesh, before we go into various sectors, it seems like we are dancing to our own tune, and it seems like at least global markets as well, since there was a lot more clarity of a rate cut in the US, markets have been selling off. So it almost seems like we bought the rumor in the last 6 months, and now on hopes of the news coming through soon, we are selling out. Do you feel like it's now time to take some profits off the table? Because for whatever it's worth, we are borrowing returns from the future with the way things are looking on the index at least.
Yeah, so I think the assessment is fair. If you remember at the start of the year, the expectation was that there would be 7 rate cuts in the US, and then that progressively kind of came down to 2 or 3. And now, with the data coming through and whatever is being said in the media by the US Fed, it's kind of now come to a conclusion that this is the case. Also, there is one more factor which is playing out in the US is that with the run-up in prices, I think some people have called for some caution. And then there is the election uncertainty, which is there. So I think what's happening is that market seems to have taken a bit of a breather for multiple reasons. At the same point in time, what you see in India is that with the RBI having said, talked about the neutral rate and so on and so forth, there is obviously some kind of view building that we may have a shallow rate cycle going forward. So lots going on in India as well from that perspective. Markets obviously not cheap. I was just looking at our own Nifty earnings number. We are at like 23 or a little over 23 times on FY25, with only 12% growth coming for the year after. We are well over 20 times even on an FY26 basis. So look, it does seem to indicate caution. Having said that, with the theme of the market, and this is not just in India, but also in all emerging markets today, is that people are willing to pay for visibility and strong growth, even if that means that in the short term, the valuations are actually looking unreasonable. And I think that the way which we have built our model portfolio as well is that we should look at longer term themes where we have good visibility on earnings growth. And, I think the liquidity with the participation from domestic investors, especially, which is coming through, and some fatigue in selling from FPIs this year, I feel that the markets may remain well supported. So while, yes, could see a time correction, are we really calling for a market falling off a cliff? The answer is not really.
So if we're not falling off a cliff, but we are still expensive,
yeah.
How does an investor then approach this market? Does one participate, continue? I mean, I know the best advice is do an SIP, and that's the only way to, play any equity market or any asset class. But what does one do? If you're sitting on a lump sum amount of money right now, do you upfront it? Do you stagger it? Do you take profits off the table? What does one do? Because it's also very mixed, right? The signals that we're getting.
Yeah, so look, for people who are already invested in the markets and have incremental flows, in any case, the obvious thing to do in that case would be that if the market does go up, you are anyways making money on the invested capital. So that's one. So you could stagger it over a period of time. Assuming that we are looking at a static portfolio, which is where the difficult part comes in, as to if you're fully invested with no incremental flow, do you take some money off the table? In our model portfolio, and generally, philosophically, we don't ever recommend that anyone goes more than 5% cash. That's the cash position we have in this. What you could do is that even that there are InvIT and REIT products you could invest in. So in our model portfolio, we have the PG InvIT is in there. But broadly, what we are saying is that for the portion where we are seeing longer-term thematics play out, we like the long-term theme on gas, for example, financial inclusion. There is some recovery on the consumer, especially on the rural front, with thematically the fact that a coalition government should be beneficial for the lower end of the consumption curve. I think what you could do is wherever you find that you are paying way above mean valuations, let's say on some of the smaller NBFCs or something, you could switch that into these longer term themes and kind of play it out through the cycle.
Unmesh, good morning, Niraj here.
Morning, Niraj.
Just trying to understand how you think about tech per se. 3 months ago, obituaries were written. And, company after company said it's too early to write an obituary because we've seen this in the past, multiple other cycles. Suddenly, nobody seems to be getting enough of IT now. And there's been a big rally. How are you positioning yourself now that we've seen a bit of a rally and valuations are no longer what they were on June 1st?
Yeah, so look, we've had this conversation last time.
Yes.
And I think at that point in time, what had happened was that, so the expectation, to be very fair, was that valuation, that the sequential growth will bottom out 2 quarters ago, right? Then there was a bit of a disappointment. And in the last quarter, we thought it will genuinely happen, and it again didn't happen. What had happened in our model portfolio is that we were overweight prior to that because of 2 reasons. One is because you obviously want to be ahead of the curve when these types of change in views happen. Obviously, for 3 months, we endured the pain of that in the model portfolio as well, right? But at the same point in time, what is happening now is that in India, you cannot be too early because there is so much liquidity chasing, and in a market where everything is so expensive, alluding to the first question as well, is that the way to play the game is to do sector rotation. So 6 months ago, we were overweight. We were disappointed for 3 months, but that whole performance has come back. At this point in time, while valuations have caught up, they are not in froth zone. And if you see the numbers, while only a few numbers have come out, but at the same point in time, last year when we were looking at 2-3% growth, this year top line growth will be 6-7-8%, 8-9% kind of earnings growth. Now, is that very exciting in an India scenario? Answer is no. But in a global tech scenario, as in companies which are going global kind of tech scenario, there is a fairly high visibility on this. So we believe that there is still more legs to the IT rally. What we are doing is that we have Infosys in there, so it's not just the IT services companies. So we do have Infosys in there, we have Infosys in there, and TechM. But what we also do is tech-enabled companies, which are actually linked to the tech cycle. So, MCX and TeamLease is also there in our model portfolio. So that's how we built our tech platform. We would remain overweight on that space.
Remain overweight on tech. Okay. Has thus far, Unmesh, let's say Q4 results and commentary and then Q1 delivery thus far, not everything is out, so it's early days. Has anything surprised you positively?
So individual stocks, yes, but overall answer is no, really. Infosys was yesterday, so our analyst has written a view that it was a bit of a surprise. I think, having said that, on an aggregate basis, as you rightly said, not enough has come out, so we're just waiting and watching. But at the same point in time, at this, we didn't have overly positive views on expectations. So even our view on the aggregate earnings for next year is 12%, single digit. So nothing has jumped out of the screen to catch our attention at this point in time. But we'll watch this space closely. I think we are very, very early into the quarter to know this.
Okay, Unmesh, I wanted to ask this to you today. We've rallied so strongly that even the most optimistic of bulls, who's saying that this market is unpredictable, I would say that, now it's a bit of a stretch, right? My question is, what can take it down if indeed, month after month, these flows keep on coming and giving this anchoring? Independent of the monthly flows, I was looking at some data which suggests that mutual funds are sitting on, a lakh and a quarter crore of cash. So even if there is a correction, it probably will be a shallow one. So is it tactically advisable for somebody who even thinks that the market is a stretch to sit on a large pot of cash, or not quite?
No, so look, this is actually, what is happening is that we have gone into some kind of unprecedented territory, which is not unprecedented in India, but it's not really unprecedented globally, where what is happening is that the financial participation, as in the financialization of savings theme, has just caught up, okay? if you look at it from the perspective, while we haven't done an independent study, but what I read from some of the studies done by other consultants is that if you have to converge to levels of equity participation in China and someday even the US, then there is a very, very long way to go on that. Now, calling at what point in time will that maximize is difficult. What I believe is happening today is what we saw in Hong Kong, China back in 2003 to 8, which is that flows continue to come in irrespective of valuations what ends up happening in this type of scenario is that markets will continue to get very, very expensive. Individual stocks tend to go to stratospheric levels someday. I was looking at one data point the other day that 1 out of 10 stocks in the top 500 stocks in India are over 100 times earnings. Now, does that mean you buy a stock at 100 times earnings? I think no, fundamentally, you cannot ever justify that. But at the same point in time, what happens in this scene is that you will then see sector rotation into the next round. So if something's at 100 and something else is at 30 may be expensive as well, but then someone will move from 100 to 30 and play that up. What is important at this point in time is two things, and which is what is happening in front of us, which is the story becomes more important than the earnings. And on earnings, if there is a disappointment, then that is the reason to sell. So what I'm trying to say is that very akin to, let's say, the Mumbai real estate cycle of late 90s, or the equity cycle in Hong Kong, China, this will run its course till disappointment starts to happen. As far as externality is concerned as to what can actually bring it down, honestly, at this point in time, we already have a war. We've had elections. There are elections in other important geographies like the US. The Fed is going to, we've gone through the peak of the rate cycle and still it's not happened. And quantitative tightening is happening. So you put it all together, we believe that there doesn't seem to be any foreseeable risk which is bringing this off a cliff. So we would see a time correction.
Right.
And in the interim, as they say in Hindi, ke wo beti ganga hai, to wo beyond a point, you try to time it too fine, then you look clever, but then you are poorer. So I think participation, you have to decide what is important to you. And I believe participation is key.
Got it. Okay, Unmesh, lovely as always. Thanks for your time. Really appreciate it. All right, now on to Kabir Shakir Ahmed, the CFO of Tata Communications, on their quarter one earnings rather.
We're quite pleased with the good start of the year, although topically you see a -1% growth. If you strip off voice and subs, our focus has always been on the data business. So the data business has grown, albeit slightly lesser than what we would have wanted. But I think it's a healthy start to the year. It's grown year on year at 20%, which is good, helped by of course M&A that we did last year. On profitability, I would say we're quite again happy. Last quarter we ended at 18.6. I would like to remind the viewers, our ambition has always been to operate in 23 to 25 range, which we have been doing until last year when we did 2 acquisitions, which were margin dilutive and pulled our numbers down. But we then also advised the market that it's our ambition to get these back. So you see the first quarter in the year. As we inch up the margins from 18.6 of Q4 of last year to 20% already this year. So I would say we are, on the right track. Growth is of course the focus, and both India and international. We maintained our stated position that we are a market leader in India, and we would like to cement that. There's a lot of headroom to grow in international markets. Acquisitions have happened in international markets. Revenue synergies will also see through coming in international markets. So there's opportunity for us to grow in international markets too. But as far as I'm concerned, both are important, both India and international.
What's the revenue contribution mix right now, Kabir, overseas to India?
Overseas is slightly over 50% already now. So the balance will tilt, and shift towards international. So for sure, yeah.
So where do you see it going? Where is it now exactly, and where do you see it going? The focus on the overseas business, because I know that you're boosting your UK subsidiary as well. So just trying to get a picture of what the roadmap is.
Yeah, no, the international will continue to grow, and it is, as I said, now balanced, around 51, 49. Kind of a situation in favor of international, and this will continue to grow. The UK subsidiary is actually a different thing altogether. If you see, our overall strategy is, of course, to double our business by FY27, and I would say that's just the start. And after that, our main focus is we need to be relevant to our customers in the digital ecosystem. We want to be the digital fabric to all our enterprise customers. So opportunities will continue to evolve, and we need to stay relevant. As part of that staying relevant and as part of aligning to the strategies, to look at our legal entities, and is our structure amenable, and is our structure aligned to realizing the strategy potential, is what we are looking at, and this is only the first step. We did already set up an entity in Switzerland back in March. Making UK, which is a step down subsidiary, a direct subsidiary of the Indian holding company, is one of the steps that we are doing, and there are several more that are there, which is going to simplify the legal structure. So whether it is an organic growth that we're going to pursue either in the UK region or I would say in international markets, or an inorganic opportunity that we would want to pursue, for which UK, Netherlands, become the right jurisdiction from where you can do a good acquisition. So those are all, I said, the preparations that we are doing to ready this company for realizing its ambition.
Kabir, let's round off with your guidance. So your margins are robust in voice, but its revenue contributions are flat at, about up, I would say, year on year, but about 8.8%, while data is the bulk of your revenue contributions. Do you see voice contributions increasing? What is your consolidated sort of margin guidance that you're looking at? You're already at 21.5. Do you see that improving over the fisc?
I would say our focus is not voice. Voice business is always managed at net revenue margin or gross margin, whichever way you look at it. That's how the business is managed. Our strategic focus is data. But the overall margin, our ambition has been the 23 to 25, as I've said many times before. We would continue to stay in the 23 to 25, guidance. We slipped back because of acquisitions. And let me remind, the three, parameters where we departed from our ambition was leverage, ROCE, and EBITDA. Leverage will get back to under 2x already this year. So you'll start seeing that come through. We are at 2.2x now. We used to be at as low as 1.3x before the acquisition. But all of that headroom we created was only to reinvest back into the business, not to stay there. ROCE was at 17.5% this quarter. We will get back to greater than 25 next year. You'll see one more quarter where it slips because of the 12-month trailing formula that we actually use. We acquired Kalera in October. So you'll see that impact for one more quarter before it starts inching back up, and EBITDA will come back to its ambition. I don't like to give guidance. I would call it ambition of 23 to 25, hopefully in 2 years' time.
By when? Okay. So 23 to 25 in 2 years' time. So are we going to stay in the 21.5% range for FY25 largely, 21 to 22?
So we are there at 20% now. We will be in that range, of 20 to 21 in this year. Okay. That's the range that we will be in.
All right. Thank you so much, Kabir, for speaking with us. That's the Chief Financial Officer of Tata Communications, talking with us about the quarter gone by and the outlook. They're sticking with their goal of 23 to 25% of an EBITDA margin over the next 2 years.
Right, back with India Market Open right here on NDTV Profit. Now, before we get to the polycap management, it's important to highlight this quarter's numbers and the expectations from some of the biggies. There are biggies today. Reliance is set to announce its results as well. And Mihika Johnson to tell us what is to be anticipated from actually all the three key businesses. Mihika, good morning.
Yes, good morning, Niraj. So a weak quarter, and this is mainly due to the oil to chemical segment as well as slowdown in the retail business. When you look at the consolidated numbers, according to Bloomberg estimates, revenues could drop around 2%. The operating profit could fall 15%, and this could lead to a 280 basis points margin contraction. And net profit is likely to fall almost 7% on a quarter-on-quarter basis. Now, when you break it down segment-wise, up first, let's talk to oil to chemicals business. Likely to see a sharp decline in earnings, and this is mainly due to lower gross refining margins. As per ICICI Securities, GRMs could fall $4.7 per barrel on a sequential basis. However, some losses could be offset by higher volumes. Up next, we have Reliance Jio, where the segment is likely to perform better, and ICICI Securities expects higher subscriber additions at 8 million. And the company's ARPU, which is average revenue per user, could also see a 0.6% uptick to 182.7 rupees. And lastly, we have Reliance Retail. Slowdown in the business is expected to pull down profit by 1% sequentially. However, the operating profit is expected to rise 3% to 6,000 crores.
Okay, Mihika, stay with us though, because Ultratech is the next one on radar, right? It'll see an expansion in margins, volumes may outperform as well. Are these the two key things, or are you looking at something else, Mihika?
Yes. So in terms of revenue growth and profit growth, it would be positive. While the EBITDA per ton could see a hit, the margins are still expected to expand, and this is amid the price weakness that we've seen across pan-India. According to Bloomberg estimates, revenues could see an almost 4% uptick. EBITDA might increase 11.6%, and net profit could rise 8%. Now, when we talk about the company's volumes, our brokerages are optimistic that we would outperform the industry. Ultratech would outperform the industry. NK predicts a 5% volume growth, and Nirvana expects a 7% volume growth. When you talk about the realization, cement prices on a pan-India level have come down 3 to 4% on a quarter-on-quarter basis, and this could affect the sales realization, and that is why the uptick in revenue growth is in lower single digits. MK expects the realizations to dip 5% on an annual basis. And lastly, when we talk about EBITDA per ton, according to MK, the EBITDA per ton would drop around 15% on an annual basis. However, it would still stay above the 1,000 rupee mark, and this could lead to cost efficiencies and help margins expand 180 basis points according to Novama.
Okay, thanks for that, Mihika. But more earnings candidates as well, and IT is the big draw. What is the street expecting from Wipro is the key question. Agam, what are your thoughts?
Right, well, so many surprises coming through all over the course of the last 1 odd week when it comes to IT companies, but more to do with the outlook. At least as far as the expectation on this quarter is concerned is going to be a relatively quiet one based on expectations for Wipro, expecting about 0.1% growth sequentially in revenue. EBIT margins are expected to remain flat at around 15.9%, and net profit is expected to grow 3.4% on a quarter-on-quarter basis. As far as the IT services revenue segment expectations are concerned, that also is expected to come in at around 0.1% on a constant currency terms, and margins at around 16.4%. What are we keeping an eye on? Well, of course, the senior leadership churn. We're expected to see a lot more commentary in terms of what the new CEO has in focus, what his plans are for Wipro going in. A possible buyback announcement is something that we're also watching out for. Traction in the consulting business as far as Capco is concerned, and we're also expecting a ramp up in the $500 million deals as far as telecommunications is concerned. So a bunch of these factors is what should be in focus as far as Wipro goes.
Okay, we will certainly watch out for this as well. Tech is the saving grace of sorts for the markets in the session today. And, it's interesting because I see the performance of some of the tech names and ER&D in particular. So pull up LTTS, for example, right? Nifty IT is up 0.8%. Pull up LTTS after the slightly tough showing. That stock is flattish, but had its moments in the green today. Tata Technologies post a miss in the quarter, came off and is down about 1%. KPIT Tech, on the other hand, is up about 2.5% and is trading now at life highs for itself. If you just do a combined chart of KPIT Tech and Tata Technologies, those are the two that we should focus on because auto-focused ER&D stocks. And by the way, KPIT Tech is egregiously expensive, but just compare the two in the last, say, 6 months or thereabouts, because that's from, I think around that time is when they started their journey together. Tata Tech, post its listing, has actually had a very somber period on the bourses. From 1300 or 1400 is when it listed. Tata Tech is actually largely had a day way down. At the same hand, KPIT Tech has actually had a really good move. So, look at that, the performance. The red line is KPIT Tech in the last 1 month, 25% higher. Tata Tech down about 2.3% or 2.7%. And I'm sure if we were to expand this chart a bit further, it'll look even more different because Tata Tech in particular, more than KPIT gaining, which it has, it's Tata Tech just not performing, which has been the bugbear for this stock. So, great subscription, great listing, but post that, somehow Tata Technologies has not lived up to the billing. Okay, we'll slip into a break. In fact, wrap it up on this leg of India Market Open. But on Talking Point, we talk to the management of Polycab and then get in Mrinal Singh from InCred to talk about his thoughts on the markets.